The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen, and good afternoon to our friends in Queensland. Good morning, actually, up here. Good afternoon to the rest of Australia and across the ditch as well. How's the volume, folks? Would somebody please type in the question box that you can hear me all right? Norbert, there you go, up in Canada, in that cold country. And Andrew, great. Thank you. No screen. Why is there no screen? Let's see why there is no screen. Here we are. Yes, the screen is there. Andrew, it's your end is having a problem. You should have a big screen saying it begins. And there it is. So you might have to refresh your browser there, Andrew. Okay, so let's see. Here our usual attendees are here. Adrian from Adelaide, Albert, a tutorial guy, Alex, Bill. Chun's a new, Chun's actually been with us a very long time. Thanks, Hank, you can hear us all right. Can you see the screen all right, Hank? Andrew's having trouble seeing it. Just type in the question box. Yes, you can see the screen. Sorry, it must be your problem, your end there, Andrew. It's all right here. Yes, Chun, I was going to say, is a new member doing a tutorial next week, but he's actually not a new member. He's been with us on and off and following us since 2008, which means he's probably close to one of our longest serving members. So delighted to have you with us, Chun. Trevor, Peter, the short-term king, up there in Warwick, Hank down in down the Hunter Valley, Donald, Philip, lots of them. Yes, Adrian, he's a tutorial guy. Another Peter, Albert, he's a tutorial guy. Albert Z, there he, Monty, a new name, glad to have you with us. Harold, the gold bug from Reading, glad to have you with us. Harold's been with us for years and years and years. And Suhasini's with us. Suhasini, we don't have many ladies, and always delighted to have them with us. So I hope you're well and happy and very rich, no doubt, eh? And Jeff's a new member, getting ready to do a tutorial. Norbert, he's a tutorial guy. And let's have a look. The Murph, Mr. Murphy, he's a tutorial guy. So Jeff, the antiques guy, wonderful. Vicky's with us. Vicky, lovely to have you with us. That's two ladies we've got today so far. That's pretty great, isn't it, David? Mark, Rob from New Zealand, my old mate, Rob H. Good to have you with us, my friend. And exciting times, aren't they? And also Akshay over there in India. Good to have you with us. Cooking a steak on the car bonnet down under, says Rob. You must be over our part of the world. Anyway, it's great. Good to have you. Okay. I'm thrilled that you're all here, guys, because I figured attendance might be a bit skinny this evening because I thought you'd all be out buying your new Maseratis or whatever. Because boy, I mean, what a week. What a week. It's just, and Janet's just joined us. Janet, lovely to have you with us, of course. Hope it's not too cold up there in Canada, Janet. It's lovely down here, I can tell you. Short sleeve weather here. It's just been an extraordinary bit of trading. And of course, if you've been following the Daniel Code, you knew all about it, and you knew all about it in advance. So let's get going. There's so much to talk about today. And let's see where we are here. If we can find a button, there we are. So away we go. So we know that markets are orderly and that they're sometimes predictable. In this case, this big move down, which undoubtedly caught a lot of people by surprise, but not you. This was very predictable. So I'm going to show you. We've been leading up to this for over a month with some very, very specific commentary and some absolutely perfect symbols. I'm starting to sound like Donald Trump, aren't I? They're perfect perfect orders in perfect symbols. Right. Well, anyway, equity markets are correcting. Well, That's all they're doing so far, folks. It's not that dramatic, although it may seem so if you're not on the right side of the market. And we used to have a very flamboyant trader in Australia. He was a stockbroker called Rene Rivkin, and he's dead now, poor chap. But he's probably glad he's dead, because he rode the top of the wave. He was a big deal, a big noise, very flamboyant, was on the television all the time, and with his worry beads. And he was famous for having solid gold worry beads. And this is, maybe 20 or more years ago. Now my memory fails me, and I think he had a gold Rolls Royce as well. But Rene had this wonderful saying once in the last time, some many years ago, the market was having a decent correction, and he said the markets are correcting, and the poor old guy who was interviewing him obviously owned stocks and shares and was losing his tail. And he said, "Oh goodness, Rene, what's the difference between a crash and a correction?" And Rene said, "Well, he said, a crash is when you lose your money. A correction is when, sorry, other way, wasn't it? I can't even remember these stories now. A correction is when you lose your money. A crash is when I lose my money." He was a real character. But anyway, the great unwashed are taking a very small beating. Lots of drama about this move, lots of media. Long time since the markets had a decent correction, about February last year, you'll recall. But it hasn't been too dramatic yet, but the way the market's been, it seems like it to many people. And the media constantly, of course, trumpeting billions of dollars lost, etc., etc. Here is today's headline: Wall Street crumbles, Dow Jones recorded the biggest one-day point drop in history, as markets continued one of the worst weeks since the global financial crisis. Well, that's absolute rubbish. That's just puffery. And that's what media does, isn't it? Anyway, what can we say about that? Well, equity markets generally, they've been madly overbought for months. I mean, correction's not very dramatic so far. It might get dramatic. Don't count that out at all. But we warned about a correction for the last month in some detail. The point is that nobody has to lose money when markets correct. The people who are losing money are people who are long stocks and don't know how to hedge. And the reality is that most people don't know how to hedge. Stocks are very hard to short them. It's not for the average retail trader. You've got to borrow the stocks, pay a fee, enter documents, all that sort of stuff. But I've been saying this for years and years. Learn to trade futures. You'll never lose money because you can hedge. It's so easy to hedge against your stock portfolio with futures. But anyway, markets that correct are safe markets. Markets that don't correct are dangerous markets. It's fair to say that the US equities markets have reached a stage that you have to say they were madly overbought. And there's you look at some of the individual stocks, what they've been doing. You look at Tesla, my God, $300 odd bucks up to $1,000, just crazy stuff. So what they worried about? Well, the spread of the COVID-19 virus, that's the immediate cause. So that's the first effect, is labour being restricted by illness or quarantine, which is interrupting supply chains. And most big businesses are using a form of what's called just-in-time stock maintenance. This was a very hot topic. I was going to say 3 or 4 years ago, but my recollection of time is minimalistic. In fact, that was probably more like 8 or 10 years ago, but I can remember when just-in-time stock levels were a big deal, and all sorts of programs were being put in place and touting the marvels of the global supply chain, and you didn't have to carry much stock. And of course, stock is a drain on your bottom line. So most companies try not to carry any more stock than they absolutely have to. And this is what you're really going to find out now, just how close to the line some of these markets have been running. And the more sophisticated they are, the more likely they are to have been tied to just-in-time for their delivery of their stocks, and they're going to be the ones that suffer first and suffer most. And globalization means that China, India, all of Asia is a very, very big player, but China's the headline player here. And that's, of course, where this new COVID-19 virus started. And what really spooked the market is when it spread to Italy, up in the north of Italy near the financial centre, and Europe. And that exacerbated the falls and really got people concerned at some depth. So what's next? Well, the spread of the virus globally determines the level of anxiety, I guess. And what we're seeing are only first-order concerns, as I say. Secondary damage is still to come, and that's going to be the cost of the medical and support services and the human cost, which is significant. Already the Australian government is flagging that the projected budget surplus is gone. Of course, they've got plenty of reasons in Australia. We had that terrible drought that went on for years and years and years, broken by the flood that did more damage. And of course, now with tourism, such a big part of the Australian international business model, it being whacked. So that's the end of the projected budget surplus. You can expect equities to overshoot to the downside. They've been so overpriced, so hyped, so zapped. I think there really is a generation of stocks, people who've never seen a correction and don't believe that markets can correct. And of course, what's happening now is proving to you that the old rules still apply. Markets are mean reverting, and no matter how long they manage to avoid that, eventually the reality is it's going to catch up with them. So what are the big targets here? Well, the physical and tech industries are the obvious choices. Motor vehicles. Sales of motor vehicles down dramatically in China. For the month, they're down 85%. Some of the high-tech companies, Apple, for example, are already flagging that their supply chain's impacted, and they're the leaders of the just-in-time bit, so they don't have many in stock. And as the global supply chain is impacted, they're not going to be able to meet their targets to deliver product. Anywhere people gather in large numbers increases the risk, and travel's being hit very, very hard. Cruise ships have been in the news, and they've been described as floating petri dishes. I particularly love that. I mean, I don't know who thought it was a good idea to be putting, 6,000 people on these cruise ships. My God. Anyway, aircraft are another standout. They've been a bugbear of infection for many, many years. In fact, for at least the last 15 years, if I'm traveling internationally, I get a dose of antibiotics and start them before I go, because every time I get on an international flight, I'm coughing and spluttering by the end of it, at least, sometimes worse. So what are the additional targets? Well, education is an absolutely massive market in Australia alone. Now, this is a tiny country. The population of Australia is about 24 million. So you can take these figures and multiply them, extrapolate them for your own country. But there's 375,000 foreign students in Australia. I mean, and a whole lot of them aren't here. They haven't been able to get here. And the ones that have, I guess, we're not seeing any great explosion of the virus in Australia, but no doubt we will. But education for the past decade, it's been an absolute boon for the universities and other institutions. If you want to start scratching your head about how are these the pro-chancellors of these some of these big universities on $3 and $4 million salary a year, look no further than foreign students. It's just been a boondoggle. 2 private universities in Australia charge $360,000 for their medical degrees. Can you believe that? And they're just filled with foreign students. There you are. So tourism already is being belted everywhere, and how long this outbreak continues to spread, that's the big unknown. And that's going to be the determinant, isn't it? So is this a surprise? Well, not to me. The SARS outbreak in 2003 was a preview, and I've been telling you for months, S&P above 4 standard deviations from the mean. Now, they're not your normal standard deviations, they're Daniel code standard deviations from the mean. As I've said, markets find it very, very hard to maintain those figures, and recently the S&P just poked its head above 4 standard deviations from the mean. I'll show you that chart as we go along. But that's just is it absurd? Well, it's certainly not. It's certainly not borne out by fundamentals or what we would traditionally think of as fundamentals in the stock market. The price earnings ratios are off the chart. Some of them are just ridiculous. And it's a bit like the We company, isn't it? It's all done with smoke and mirrors, and eventually when the real dollars have to come out, they're not there. And Warren Buffett's famous quote, when markets pull back and correct, you can tell who's been swimming naked. In other words, it's only then that you find out which were the really strong businesses and which were the ones that were more hype than reality. And there's plenty of those all around the world. Don't worry about that. Ships, these cruise ships have been in the news. They're terrible, with ones that have been locked up. That one in Japan, I mean, God, just one after the other, terrible. Aircraft, always a health risk. Probabilities of a viral outbreak emanating from China have been known but discounted. There was SARS, there was the bird flu. This is not like, wow, this is a great surprise. Is this a black swan event? Well, not really, because it's happened before. The only difference is degree. This is not, gee, I'd never have thought of that. I mean, there's a history of new viruses coming out of China. They seem to be connected to some of the cultural practices over there. Eating bats seems to be the one of the prime culprits, but that's maybe just hearsay. But the recent stocks mania certainly primed the pump, and nowhere more than in the US. And I've commented to you before very recently, the long-term chart in the NASDAQ looks like a commodity having a blow-off top. And equity markets generally don't have that pattern, but that's certainly what the pattern in the NASDAQ's been. I showed you a chart at a recent tutorial of all the support lines going up higher and higher, the very definition of a blow-off. Anyway, here's our friend, the best guide to what's happening in markets. This is the S&P E-mini. And as you can see, the thick blue line running left to right up the page, that's the median. And the lines above it are each one Daniel code standard deviation. So count 1, 2, 3, 4, and see where the market was just before this little pullback started. The market was above 4 standard deviations from the mean. I can't find a precedent for that in the S&P anywhere. It has happened in the NASDAQ before. It happened in the dot-com bubble, but I can't find a precedent for the S&P to have done that. And if you have a look at this chart and burn it into your head preferably, you can see the pullback has still got it a bit more than 1 standard deviation above the mean. It hasn't even got back to the mean yet. So I think we can see a whole lot more coming before this is over. Right, so here's the question. Did we do our job? Have we prepared you for this event? Well, you'll recall last month I ran a webinar for you called Suddenly You Need Futures and Forex. And the whole point of that was to stress that these wonderful futures markets and Forex markets, they pay exactly the same going down as they pay going up, unlike stocks, which for retail punters are basically long only. And I showed you how overbought markets were and commented again that markets find it hard to maintain those levels at or above 3 standard deviations from the mean. So they were general comments, and I guess you needed a lot more than that. So let's see what we did. This is the 4th seal, folks. Now, for some reason that escapes me, very few of you are subscribed to this service. But a young Belgian gentleman called Frank DB runs this service for me, and that's why those of you who are subscribed, you can see some typos in it occasionally. We used to correct them, but of course Frank is a Belgian gentleman and English is not his first language, but we think he's so good, and I didn't want to interfere with the flow at all, so we've stopped correcting them for him. But you can see now, this was posted, this is on the Daniel Code under the fourth seal, and he covers gold and crude oil and the S&P. This was for the S&P from last week. This was posted on February the 17th, and the way it works, he gives you the comment from last week and then the comment from this week, so you can see the continuity. And you can read this for yourself, but here's the main point which I've underlined for you. Plenty of opportunities to top in the next 2 weeks. Well, how prophetic was that? Odds are the next major high is right around the corner. There you are, black and white. It was there. Those of you who were subscribed to this service got it. Those of you who weren't subscribed didn't. Let's see what happens after that. This was his latest posting the week after that. This was posted on the 24th, the beginning of this week. So far, we have had a decent top in the SPX last week on the 59 cycle stop. He uses the index for his forecasting, which is the correct way to do this. This coming week, there's another 59 cycle top coming up, running until March the 2nd. After that, there's a third one. See what I've highlighted and underlined for you. We either saw the top for this rally already, or there is another attempt to rally coming up that gets us to new highs in the second or third DC cycle later this week and early March. Well, that didn't happen. We have to follow the DC signals. The top is in or it is just around the corner. Odds are that we are close to a major high in markets, regardless which scenario. Now, I can't stress that to you enough. If you're not getting the fourth seal commentary, you are doing yourself a gross disservice. And for some reason, it hasn't been particularly popular, but it should be. This is not the first time that Frank has nailed these sorts of turns very, very well. But the key thing is, which is not underlined, we will have to follow the DC signal. In other words, like all indicators, the fourth seal, which is an angle which combines price and time, it will show support and resistance. In other words, it's forecasting with a high probability spots to get a vibration in the market. But nothing speaks to quantum. And for that, we have to get the DC signal. So, as you know, those of you who follow our signals, a large percentage or a not inconsiderable percentage of our signals are not elected. In other words, they've reached time for a vibration, or they've reached a price level for the vibration, but then we are never of the opinion that we know what the market's going to do. We have no foreknowledge. We don't know what the market's going to do tomorrow, and we don't need to know. Nobody knows. Anyone who tells you they know what the market's going to do tomorrow, run a mile. It's just not true. Nobody knows. We do not have foresight. We only see the river of our life looking backwards. That is, we know what's happened, and we can see that and enjoy that, hopefully, and learn from that. But we only see the flow of the river backwards from now. Only God sees the river bunny running both ways, both forward and back. We do not have that gift. And that's why the final trigger for all of these signals is that we publish the number at which the trade will be elected, and the market needs to support our hypothesis by saying, yes, we agree with that, and the market will go to that number. At that stage, and only at that stage, the signal becomes elected. So that's what he's talking about, saying we have to follow the DC signals. They're the TO3 and the plus signals, and now, of course, the success signals. But he's nailed this. This was posted on Monday. The top is in, or it is just around the corner. Odds are that we are close to a major high in markets, regardless which scenario. So let's have a look now how the DC time cycles identified the top. And we're going to leave the PowerPoint for a little while and go to the charts, but don't leave because there's much, much more to go, and we're going to come back to the PowerPoint when I finish showing you what occurred on the chart. Let me just minimize this, and here we are. This is the S&P. This is the S&P E-mini. And here I want to take you back to the start here. And you can see there's a little cluster of 3 bars there. I've got the blue line, the main line from the cursor is now on there. I put it on there, and that date is November the 5th, 2019. And you can see from the later low, we've got a big low bar here. This is a daily chart. We've got a big low bar here on December the 3rd. And the low of that bar was 3069.50. And if you take a line from that, you can see that this little structure where the first blue line is here, this structure, this gave you a counter trend. This gave you a counter trend low. This was a swing low in an uptrend. So if you look where the close was, this market did not close below that blue line. So that qualifies, it's very marginal, but it qualifies as the low before the low, or a low before the low. There are many. Now, you've seen this pattern before. Remember, in February last year, we had the big sell-off, and in a couple of tutorials, I took you through these charts with the DC basic time cycles on them, 44, 59, 62, and 70, and I showed you every high and every low that came for months and months after that. And it all started from this pattern of a low before the low. And once we find that pattern, it's telling us that the time cycles are going to be particularly active and accurate, and that every swing high and every swing low should be followed. So let's move along from there. And this is where we were to start with. There's the swing low. And remember, I'm sorry, we're 1 bar off. There's the swing low. And remember that these bars are valid for plus or minus 1 period, these time cycles. So, you know, we're talking about being back in November, forecasting what's happening in January all the way up to February in the following year. This is very long-term forecasting. And we can do this, Frank, in the fourth seal does this for 12 and 24-day charts as well. But this is the daily. So the reason that they're valid plus or minus 1 period is that you can start this count either from the bar high low or the closing high low. In this case, as you can see, this previous bar, 1 back, that's the bar of November the 5th, 2019. That's the closing low of that little swing down. That is a valid swing low, but this is the closing low. And if we go back and we place our start on the swing low as opposed to the chart low, look what you get at 44. You get this great big outside bar that reversed the correction and started this big run up into the penultimate top. When we go from there, we need to keep moving this along because we're interested in every swing high and every swing low. This is the next swing high. Remember, it could be on this bar or the previous bar because the previous bar is the closing high of this swing. Look what this gives you. This gives you the January high on the 44-day cycle. It also gives you this little high, which led to a 2-day correction. This was just an early pop-off on February the 17th of what turned out to be the ultimate high. Follow me as we move this along. Here's the swing low. There's the actual swing low itself. Next, what do you get? An inside bar. What do you do if you get an inside bar? For trading purposes, we treat inside bars as null or void. Now, don't get confused and shout at me about this. For forecasting purposes, using the fourth seal where we're using angles that include time and price, the inside and outside bars are very, very important. But for trading purposes, we treat inside bars as a null or a void. Because what's happening here is that markets have their own inbuilt clock. They have their own particular time frame. And it's not a logical time frame. If you want to spend a great deal of your time working it out, it doesn't work on linear time. It's something else. But essentially what's happening is when the market thinks it's got ahead of itself in time, it puts in one or more inside bars to waste time until it can catch up to its own internal clock. In other words, it's like running on the spot. There's movement but no momentum. So for that reason, when we have an inside bar, we just treat the null or a void, and we move the indicator on to the next bar, which also was an inside bar. But look what this gave us. There's the low in January. Then you got the 3-bar rally and the final low there. Look what these highs have given us here. The 59 gave us what is, believe it or not, that bar there, February the 17th. That's actually, I think, the closing high. 3388 was that close. This close, no, this was the closing high, 33825. It's close enough, wasn't it? With the blue line, that gave us the high. February the 20th, 2000. Here we are, February the 20th, 2020. That was the high of this whole rally in the S&P since 2009. Excuse me. Where did it come from? It comes from a little inside bar back in November the 22nd, 2019. So from November, the Daniel Code time cycles have forecast the high, which came in on the 20th of this month, in January. In February. And you've seen this before, the high, the low before the low. You recall when we did all that analysis of the last big pullback in the S&P around February last year, we did exactly what I'm doing now. We went through every swing high, every swing low, and what it showed us. And there you are. That nailed that high absolutely, perfectly, and completely. Let's move on to the next one. Right here, this is a swing high. It has a lower bar on either side of it. It's pretty subtle, but it's there. Now remember, it doesn't actually have to be a lower low. We can call it a lower bar if it has any of these three properties, either a lower high or a lower low or a close less than the open. In fact, that's the closing high of that whole rally. Look what it's given us. Now we've got the same high. This is the high, this outside bar here. This is the high on February the 20th. Now we've got it on the 59 cycle. Okay, on the, I'm sorry, that's right, the 59, I've covered up. The 50, I'll move it off so you can see. We've now got it on the 59 cycle. We had it before on the other cycle. So we've now got that twice. We've got two cycles. And as well as that, look what the 44's given us. That's the low of that whole move down. And it's come 1 bar early. Okay, it's accurate to plus or minus 1 period. That's how we got that low. Let's move on from there. Here is the next swing low. And these numbers, these dates here, March the 12th and March the 2nd, they mean something. They mean a whole lot. We'll find out what as time goes on. This is the next bar. This is the swing high. It could be this bar or it could be the inside bar there. And that would forecast the next dates as being March the 3rd and March the 6th. You'll find that these will coalesce and you'll get multiple numbers. And let's move along here. Right here, that's the swing high because you've got a down bar and then little inside bar afterwards. And that gives you the closing high of that whole move up. So these time cycles to identify those turning points have been absolutely perfectly accurate, as they always are. And these price lines down here, these timelines will start to build when we're going to see a bottom in this move. And preferably that will come on one of the moves that has multiple different times on it. So you can see how that worked out. So there we are. So let's go back to our PowerPoint and let's move on. So I've headed this thing Helpful Idiots. It's probably me just being unkind, but on Tuesday of this week, when the downturn started to accelerate for the first time, it wasn't a big deal, but CNBC came out and said that there were record lows in the 10-year bond and in the 30-year T-bond. And that was supposedly the cause of the accelerated sell-off in equities on the Monday. They posted this in an article on the Tuesday. Of course, almost all financial commentators are part of the great unwashed. They're like brokers. They're really salesmen, and most of them, now there are exceptions, I don't want to defame everyone, but the vast majority of them don't actually understand what makes markets move there. The chicks are a clickbait, and the blokes are generally well-intentioned newsreaders. So that bald statement that's being an all-time low, or the record low, it said, in T-bonds drove me to the chart. Now, you've seen this chart many times. I've shown it to you since 2008 when we, started the Daniel Code website. And this is US T-bonds, and it's absolutely extraordinary that since the super crash low in 2000, this whole conglomerate of this largest and most sophisticated of markets has run inside the Daniel Code trading channel completely. And for those of you who are reading this chart, you can see that sometime in July 2017, we stopped the channel. But it's kept that channel ever since. Look where it made its high up here. Look where it's made its low. Now remember the T-bond charts, the interest rate is the inverse of what the chart's doing. So if the chart's going up, that means interest rates are going down. So if what CNBC said was true, we'd expect to see bonds up above the upper level of the Daniel Code trading channel, which they weren't. In fact, they're just crossing the median now. There's nothing terribly dramatic about that, I can assure you, except that how amazingly accurate these charts are. So don't waste your time. If you want to watch financial commentary on the television, treat it as entertainment. If you really want to know what's happening with markets, come to the Daniel Code. So here we are, Aussie USD. Now, for the past 8 years, I've been showing you this chart, and most years, including this year in our January tutorial to say what was going to be worthwhile markets this year, I said to you, you remember, this market has to get down into those black numbers at least, and I think it's going lower. But we've been calling this as our best short for the last 3 years, and we referred to it generally for the last 8 years. But look where it's down now to 65.56. It is impossible in my mind to believe that this market was for many years, around 2010, 2011, 2012, was actually the Australian dollar was worth more than the US dollar. To me, that's mind-boggling. We're a country that's a net capital borrower. We don't create enough money in this country to fund all the projects that need to be done, or that the government wants to do, I should say. And how this could at any stage be up at $1.08 US, it's just totally beyond me. But we told you it would have to get down into the black numbers at least, and look where it is now, right down at that 65.50 number. The which of course the media say is the lowest number since the global financial crisis, which like much of what the media says is simply not true. You can see the red line at the bottom. In 2008, this market was down at 60 cents, and it's historically, of course, been much lower than that. So this has continued to be, excuse me, a good short, and particularly this month, this year, I told you, in the first webinar of the year, when I tell you what I think markets might do, we named this as the best short for the year. Okay, so let's have a serious look of what we've been telling you to do. Now, for those of you who are new to the Daniel Code, all of these charts, and there's over 30,000 of them now, since we started the business in late 2008. They're all on the website, and you can click on Chart Archives and you can see all of these charts. They're filed by date and by market. So anything you see here, it's been warehoused, it's there available for you to verify it, and we don't make these things up. It takes an enormous amount of time. I probably spend 80 hours a week just doing charts. This week more, because I've had to redo them every day this week. But as well as looking at the accuracy of these signals, have a look at, I mean, if you ever wanted to stress test your program, there could be nothing better than this level of enormous, powerful volatility. This is when everyone else's programs collapse, not the Daniel Code. Look where these markets have been running to. You can go through the earlier ones. They're on the website under EJAZ. I'll come back to you as we move along. All of these charts are filed automatically under Chart Archives. Look where this big move's ended. Well, for today, at least. That doesn't look like it's going to rally from there straight away. It's closed right at its low. 2995 is the red line. Let me bring up a chart and try not to lose this one as we go. Let's have a look at that. ES. Here it is. Here's our low for today. 2949.25. It's got a way to go yet. The numbers I got were earlier. I had this as there's the S&P mini. Oh, this was the 5 o'clock. This was the quarter to 5 figure. It's gone further since then, but it's been bouncing off these numbers just absolutely beautifully. Anyway, there's $18,600 per one E-mini contract sitting right there, smiling at you. So let's move on. It hasn't just been the S&P, of course. This is the Russell. And I've been suggesting for a while, with the size of the margin that the S&P's got up to, that the Russell is pretty good market for you to be looking at, equity traders, because the margin is significantly less. Have a look at this thing. It's roared down. Again, this chart that you're looking at, this was the chart at quarter to 5 before the markets closed. The market actually closed right on its low at all the way down at 1481.8, and if you look, you can see there's a blue line at, are we on the right chart here, Russell? 1496. It just keeps down a bit lower. 1483.7 is the Daniel Code Daniel Code blue line, a bit below the black line. 1483.7. And the low here was 1480.3. I mean, it's extraordinary that in the close, remember, these target recognition is valid on the bar high low or the close. Here's the close, 1481.8 against 1483.7. Extraordinary, the size of these bars and the accuracy of the Daniel Code. Let's keep moving. There was another 8,500. Now we got to Germany's DAX. We have a small number of very, very keen traders who trade the DAX, and it's a big market with a big margin, and it actually finished up today. It's actually through those levels. It's actually, its low today is at 12,136.5. 12,136.5. And what's our nearest number to that? Is 12,122.5. Hasn't quite got there, but it's not far away given the size of these bars. That's over $35,000 per one contract, and you can see where the TO3 signal came. Just on the perfect day you wanted it to. Let me go back because I've missed a point with the S&P E-mini. What I put up here is this cell here was a blue line and a TO3 cell signal. Now, the TO3 signals are daily signals. They're valid for 2 days, including the day of posting. The blue line signals use some additional studies. They are the strongest signals that the program creates. and we expect those blue line signals to run a bit. In this case, it's run perfectly, but this was no fluke. We had a blue line and a TO3 signal right at the high, which should have got you short. Now, I know many of you won't have been able to hold short with this sort of volatility. That's okay. The markets are not going to stop tomorrow. Don't beat yourself up if you weren't able to hold on to these trades. There's massive risk on these trades, and you need to be a pretty experienced trader to keep going with it. But the trading over this period, it's not just in the equities. That's a one-card, one-trick pony. Look at T-bonds. We've made 5,000, nearly 6,000, 5,900 plus $6,000 in one contract in T-bonds. And let's see where it closed. I'll check against the current numbers. Here it is. It closed at 168.03. It's closed at the early market close was 167.17, right on the 167.15. It's gone up. It's closed now up at the next number. It's only 3 ticks away. 168 is the Daniel code blue line. The actual code 168 and 3 ticks. I mean, that's not even the thickness of a hair. So if you want to look at stress testing your model, this is it, folks. It's never going to get more volatile than this, and you can see these markets just absolutely incredible. This is gold, so I'm glad, very glad, that we've got our resident gold bug with us. Let me see here. Bear with me a moment, folks. I'm trying to find a chart. Anyway, Harold probably knows all these numbers by heart. Harold is a long time Daniel Code member at Redding in California. This is gold, Harold, if you've been watching it. We had a Huey buy signal for the first little run up that ran 3 days up. Then we had a 2-day counter trend. Now, for those of you who don't know, the Huey is an index. It's the index of unhedged gold producers. It's 20, used to be 25. I forget what the exact number is now. Gold producers and that don't hedge their output, and it's a proxy for both gold and silver. In fact, gold and silver and the Huey are so highly correlated that a signal in any one can be executed in any other, so long as the trade is elected. Now, we have the same thing, don't forget, with equities. US equities and Germany's DAX are so highly correlated that a signal in one can be executed in the other, so long as the trade is elected. So I've shown you what we did in the S&P and Russell. You might want to take that trade in the NASDAQ or the Dow, and if you did, that's quite valid, and you've done exceptionally well. So here we are with gold. Interesting thing, I want to get that point across to you about the Huey and more importantly about market correlations. Be aware that many of these markets have correlations, and if you're trading both those markets, for example, if you're trading gold and silver, essentially from a trading point of view, you're trading the same market because the probability of them moving in the same direction, but nothing as to quantum, but moving in the same linear direction is huge. An interesting thing here, Harold, which will attract your attention, silver has had a couple of massive bars down. We had a huge sell in silver. And look at gold, it's holding on so strongly, it's rallying. That's showing tremendous strength for gold to be able to maintain that position. And you can see, of course, where it went down to. When it did its pullback, it went straight back to 1626, the red line. That was it. It bounced from there. Where did it put in its high today? 1662.2 is the Daniel Code blue line. That's where it went to. This doesn't happen occasionally, folks. This happens all the time, all the time. So here's silver that I was talking about. The gold's looking so strong. Look at the big sell-off in silver, $4,000 in 3 days, Harold. We got, excuse me, we got a correlated buy signal in silver to start the run up. Let's see if I can find that chart. Is here. Which was on February the 13th, and we had a buy signal in the Huey. as often happens, we didn't get a specific buy signal in silver. And you can probably see why, because the immediate low there's nowhere near the number. It's just wandering. It hasn't locked onto its Daniel code numbers. But we did get a specific buy signal in the Huey. So we executed the Huey buy signal in silver, which is what you do. And off it went, 4,000 on the way up, and the 4,000 on the way down. You can see the gap down after the high bar means the true low is not the chart low. The true low is actually the close of the previous bar. So 4,000 going up, 4,000 going down. I mean, it's just extraordinary. And given that gold is in such a strong position, Harold, interesting dichotomy there. And of course, our trading is not restricted to futures, folks. We have a very, very active Forex group. And here's one of the big trades in Forex this week. This is Loonie Chief Canadian dollar ad against the Swiss franc. And look at it, made a perfect signal. It wasn't quite a blue line signal. It was trying to be. It certainly found that high blue line almost to perfection. In fact, I'll tell you exactly what it was. Here we are. Cat Chief was that high. The high bar was 7,444, and look where the blue line was, 7,445. One tick, one 7,000th of a point was the only variation there. That's how accurate these markets are. Look where this thing closed today, 7,227. There's the Daniel code number, 7,224. Only 3 tick variance, extraordinary stuff. So another 1,900 there. So if you've been adding all this up as you move along, folks, well done. And you can add to that crude oil. We had a blue line and a TO3 sell in crude oil. The blue line is no longer on this chart, but I can tell you it was somewhere very close to that red line at 54.58. Blue line and TO3 signal. The signal was created on Thursday, February the 20th, to sell the next day at the true low, -2 ticks, which we did, and so far that's produced $7,000. I don't know if you can keep adding this stuff up, folks, but the money has just been absolutely enormous. Volatility does that for you. Now, 6S, some of you have been looking at 6S. There's about $45,000 in current profits just in the 6S markets. There are 11 markets in 6S. I'm going to show them to you. Let's see the page. But this is basically a program that tries to keep you with the trend, because the big money is made when we get these decent multi-day trends. That's when you make the big dollars. This is a program that does that. If you haven't already seen it, please go and get yourself a free trial. And look through it. I'm going to show you that whole page in a moment. But I wanted to just bring your attention to the post from last month. This was a slide that you saw last month about repos, the silent killer. And JP Morgan have been leading the smoke and mirrors and leading the stage that it's been manufactured to an extent. But the fact that there's real liquidity stress in the short-term repo market, which there shouldn't be. The market should have been as flush as can be. If there are going to be any big headline-type failures, this is where it's going to happen first. And the Fed will have to open their shoulders about all of that, I suggest. Okay, if you have not got a political opinion, but you're simply a trader, this is the booster in chief. I mean, the market's going to need some support to get back to where it should be. And because whether you like him or not, this guy is a fantastic booster in chief. Let me show you just quickly so we don't get sidetracked. I wanted to show you what's been happening in 6S. And to that extent, let's go to the Daniel Code website. and this is where the signals are every day, folks. This is where the fourth seal is, S&P crude and oil. And let's have a look at all of the success signals for today. Here they are. All of these are in profit. Coffee we're long, crude we've made 6,250 on the current trade. Natural gas 4,000, that takes you to 10,250. Russell is almost 9,000 in profit. Say 19,000, another 19,000 for the S&P. That takes you to 38,000 profit. Soybeans short, it's in profit. One bar stop. Sugar 744. That's about drinking money compared to these other ones, but of course it ties up nicely with T-bond 6,500. Together with sugar, there's another 7,000. So whatever the number I was thinking of before, it's about $43,000 in profit sitting in the S&P, in the six seal accounts. Does this happen all the time? No, it doesn't. But we are having exceptional volatility, and it will come again. The thing that is sure to happen, the thing that is sure, is that from this big correction, we're going to get continued volatility for quite a while. So do have a look at the success if you haven't already. I mean, the money is phenomenal, but so is our TO3 and Blue Line trades. This is, if you want to be a super trader, if you want to be able to do all these things I'm showing you here and do them for yourself, you should think about taking a Daniel Code tutorial. Think about this, folks, that for people that are near and dear to you, or good friends you might have, relatives, for goodness sakes, do try and get the message across to them about the Daniel Code and the ability to make money with markets going both ways. I talked to one of our very good traders last week, who's having a huge run, but in the process he said his wife doesn't know that he trades. And I said, well, you know, this stuff really should be for your family. If you've got that gift, your family should know about it, so they've got it when you're gone. So I do urge you, I don't say this often, but for goodness sakes, do tell people what the Daniel Code's capable of doing. Do tell your friends, go and shout it from the rooftops. You've never heard me say that. But it really is so extraordinary. It's sad to think that there are people losing their tails because they're just ignorant and they just don't have the will to learn. But even if they don't want to learn, you only have to follow what we do at the Daniel Code. You will make an awful lot of money. If you want to go to the top level, learn all these skills for yourself, do a Daniel Code tutorial. We have spaces available, and we do them now by video, just one-on-one, you and me, and it's worked extremely well. In fact, our video tutorials, the actual results of the teaching are, I think, superior to the face-to-face tutorials, which is why at our last face-to-face tutorial, I wrapped it up by doing 4 video sessions and recording them for the guys who were at that tutorial at the Gold Coast in November last year. Anyway, folks, if you haven't already had a free trial, please avail yourself of it. Go to the Daniel Code website, www.thedanielcode.com. Just click on the free trial button, follow the prompts. Any problems, Terry at support@thedanielcode.com will be happy to assist you. And if you haven't had a free trial of Trade Navigator, we can arrange that for you as well. Here's our compliance statement, folks. For goodness sakes, do read this. The risk of trading futures and commodities is substantial. And if you don't know how to trade, you're going to lose your tail. I do beg you, do not risk real money trading futures or Forex markets until you have proven to yourself, preferably and me, that you're competent to do so. And if you'd like to learn how to be a super trader and to be a very safe and effective trader, send me an email and I'll be happy to call you. and have a talk about your trading, what your aims are, and how we can assist you to get there. So I think that's about it for today, folks. We've had an enormous day. I hope you've enjoyed it. Everyone stayed with it till the end, which is great. And follow the signals. There's going to be more drama. It's not over yet, and don't think the first rally means the party's over. There's going to be more to come. So thank you for being with us, and I'll look forward to hearing from you, and I'll look forward to meeting with you all again at our next webinar. Good night for now.